Which account should you save into first? Is it the RRSP, the TFSA, or the new FHSA or First Home Savings Account? This question is asked by every client we meet. So after some Google search, I found a chart online that was created by Wealthsimple. And I think it provides a good visual on the decision-making process for which account to invest in first. However, there are some points in there that I don't quite agree with as a financial planner. So in today's video, let's go over the chart together, and I'll elaborate on things that we should pay special attention to, and also what are the other considerations that I think the chart completely missed, so we can make a better choice on where to save our money. So let's get started. This chart starts off by asking us various questions to determine our current financial situation. Then you simply follow the lines, so it leads you to the next question, and eventually you'll reach TFSA, RSP, or FHSA. So the first question is, does your employer offer group matching or RSP matching? So to understand how employer matching works, you have the option to choose a certain percentage to contribute towards this group RSP plan. And your employer will basically match your contribution, either in full or partially, up to a certain percentage. Based on my experience working with clients, and most of them are from the tech industry, the most common structure I see is where the employer is willing to match 1-to-1 up to 6% of their salary. For example, if your income is $100,000 gross and you want to take full advantage of the employer matching, then you will want to contribute 6% of $100,000, which is $6,000. Into the group RSP plan. And this amount is usually deducted directly from your paycheck. Then what happens is your employer will match it. So if it's 1-to-1, then what it means is for every dollar that you contribute, your employer will also contribute $1 into the plan. So on top of your own contributions of $6,000, your employer will actually contribute another $6,000 into the plan. But if your employer only offers a partial match, then the most common partial match we see is where they match 50 cents to $1 of contribution. So in this case, you might only get $3,000 instead. Regardless if they do partial or full matching, it's obvious to see that this is free money from your employer and is the best thing you should save into before anything else. Most employers only offer group matching with RSPs, but there are companies out there that offer group matching into TFSA as well, even though this is very uncommon. A good benefits package could include employer matching, stock options, RSU, or restricted stock units, or health and dental plans. So it's important to focus on the TC or the total compensation because it would factor everything in: salary, bonuses and commission, the benefits that we just talked about, and also amenities at the office or even gym memberships, as well as free food or drinks at work. But that's a separate topic in itself, so let's dive into that another time. A lot of clients also ask me if they should continue contributing into their group RSPs if they're already contributing the maximum the employer is willing to match. And my answer to that is don't do it, because most group plans offer a limited amount of investment choices. So the funds you could choose from might not perform as well as the ones that you can find elsewhere if you know where to look. The next question is, do you have debt? And then it goes on by asking if it's a high interest debt or a low interest debt. And since high interest credit cards usually charge around 20% interest, it leads you to the stop sign where it says that you should pay off your debt first before even considering investing. And when you have a low interest debt like a mortgage, then the next question will be, do you have an emergency fund? The general rule of how much you should have in an emergency fund is around 3 to 6 months of your monthly expenses. But what I usually advise clients is that it should actually depend on how stable your industry is and how confident you are about keeping your job, or in the off chance that you get laid off, how quickly can you expect to find another job? Based on the answer, you might want a bigger emergency fund to cover 9 to 12 months worth of expenses. Now, the placement of this emergency fund question is what I don't agree with, because having an emergency fund, even a small one that can cover just 1 month of expense, is arguably more important than paying off a debt, even if it is a high interest debt. Because living paycheck to paycheck is dangerous for your finances and brings a level of financial stress. So having even a small amount of emergency fund can bring you a lot more peace of mind, knowing that you're still going to be able to cover your bills, your rent, or your mortgage payments if something unexpected happens that prevents you from working. So for me, I would actually ask about the emergency fund first before asking whether or not you have debt. And if you don't have any emergency funds at all, then I would actually suggest you to start saving at least 1 month worth of expenses as your emergency fund. Once you do that, then you can consider paying off your other high interest debts. That being said, you should always pay off your credit card minimum payments, even if you don't pay it in full. because if you don't even pay the minimum payment, then it could really hurt your credit score. And this makes it a lot harder for you to buy a car or a home in the future. And if the answer is yes to having an emergency fund, then the next question is, what are you saving for? So in here, they list out 3 different purposes. The first is short-term purchase, and it just directly leads you to contributing into a TFSA. This is because TFSA is the most flexible account out of the 3, and it allows you to withdraw the money tax-free for any purpose. I would make a correction to this category though, because instead of calling it short-term purchase, TFSA is really the first choice when it comes to saving for any sort of purpose, unless we're saving for our first home, or we're full-time studying, or we're saving for retirement. The next thing we're saving for is the home purchase. So under here, it'll ask you if it's for your first home. And if yes, then the first home savings account, or the FHSA, would be your first choice, because it provides a tax deduction like the RRSP, and it allows you to withdraw the money tax-free as well for your first home purchase. Another advantage it has over the RRSP is that it does not require you to repay into the account after withdrawing the funds, unlike the RRSP home buyers plan. And if it's a no, then it goes back to contributing to TFSA, because like we said earlier, TFSA is flexible and could be withdrawn for any purpose. Here's another question I would add though after you answer yes to saving for your first home. And the question would be, do you plan to buy a pre-built home or a pre-sale? Pre-built just means that it's a unit that it's ready to be moved in, and pre-sale means it's a unit that hasn't been finished building yet, so it's not ready for move-in. Pre-sale are becoming more and more popular, especially in cities like Vancouver or Toronto. The reason why this is an important question to ask is because in order to qualify for the tax-free withdrawal under the first home savings account, the unit must be pre-built and be ready to be moved in. So if your answer is that you're going to purchase a pre-built home, then yes, we can still continue on and contribute towards the FHSA. But if you're looking to purchase a pre-sale, then FHSA may not work the way that you want. Because typically what happens is that you'll need to put 10 to 20% deposit on a pre-sale unit, and for the deposit amount, you actually cannot access any funds from your FHSA or your RRSP until the pre-sale unit has finished building. So this means that the 10 to 20% deposit that you need to make will need to come from elsewhere other than your FHSA or RRSP. So usually people would save that amount in their TFSA instead. So if you're looking to buy a pre-sale, make sure you save the deposit amount into your TFSA first, and once you have enough for the deposit, then you can start maximizing your FHSA and then your RRSP, because you'll still be able to withdraw from those once your pre-sale unit completes. Now on the flip side, if you're planning to buy a pre-built home, then you should maximize your FHSA first, then your RRSP, and last will be your TFSA. Now you might notice right away that this is actually going against what the chart is telling you, because it says here that once your FHSA is maxed out, head back to the chart, and the next question on that is, do you earn more than $50,000 a year? And if the answer is no, then you'll be directed to save into your TFSA. This is the wrong way to do it, and let me explain to you why. The question of making 50K or not is actually based on a myth, where people say that if you earn less than $50,000, then RSP isn't worth doing, so you shouldn't save any money into your RSPs. The rationale behind this is when you're making over roughly $50,000, you're in the marginal tax bracket of 28.2%. And if you're making less than $50,000, then your tax bracket will be lower and it will be 22.7%. So what that means is if you're in the 28.2% tax bracket and you buy $1,000 of RSP, then you would actually get a tax saving of $282, which is 28.2%. Now compared to if you're in the 22.7% tax bracket, for the same $1,000, you're actually going to only get back $227 in tax savings. This means that you're getting 24% less in tax savings for the exact same amount of RSP contribution. So it actually makes it less tax efficient. And they also say that because you might be earning higher income in future years, so you should just save the RSP room until you reach the higher tax bracket. And in the meanwhile, you should just contribute into your TFSA. My take on this is, of course, ideally, we want to use our RSP when we're in a higher tax bracket, because it allows us to save as much taxes as possible. But it's definitely not as clear cut as this, where you just say, if I'm making less than $50,000, $50,000, then I shouldn't invest in RSP at all. Because for example, if you're earning less than $50,000 and you're looking to buy your home in 5 years, then it's still better for you to save into your RSP so you can get the extra tax savings every year and you can reinvest it into your RSPs and actually compound your tax savings. Here's the math to show you the difference in down payment when you're saving in your RSP versus TFSA. So assuming someone makes $50,000 and they're able to save $5,000 each year, let's see how much he would have for his down payment in each scenario. So starting with the first row in year 1, he would contribute $5,000. And if it went to RSP, then he would get $1,003 in tax savings based on his current tax bracket at around 20%. Then he can use the tax savings towards the next year's contributions. And assuming he had 6% return on his investments, he would have $5,300 by the end of year 1. And if we look at the TFSA side, we can see that we have the same contribution amount, so our ending balance would also be the same at $5,300. But when we look at year 2, our RSP contribution would now be $6,003 because of the tax savings he got in the previous year. So this year, he would get $1,204 from the higher contribution amount. And by the end of year 2, he would have $13,044 in his RSP. Versus if we look at the TFSA side, the contribution amount would stay at $5,000 because TFSA doesn't give us additional tax savings. So by the end of year 2, TFSA would only be at $10,918. So we can see a difference of over $2,000 for your down payment. So if we compare how fast it took him to save $35K, because RSP Home Buyers Plan only allows up to that amount for tax-free withdrawal, it would have taken 4.5 years with RSP versus with TFSA, it would have taken 6 years. That's 33% faster, even if you're making less than $50,000 and you're in a lower tax bracket. So generally speaking, RSP should still come first before TFSA when it comes to saving your down payment for your first home. The only exception is if you want more flexibility with your money. So for example, you're not sure if you need to use the money before your first home for anything else like a car or a vacation, or you know for sure that you'll be making a lot higher income that would bump you into the next higher tax bracket within the next 3 years. Because in this case, then it would make sense to contribute into TFSA first, to wait until you have a higher income. Then you use your RSP and get even more tax savings. Now going back to the chart, what about the next question, which is, do you earn $110,000 or more? Let's address this for the purpose of retirement. So if the answer is no, then they asked whether or not you're gonna make $110K or more in the next 3 years. Now why is $110K a special number? To understand this, we'll need to look at the income tax tables. And we can see that as we go up in each tax bracket, the tax rate jumps are relatively small compared to the 50K mark, which went from 22.7% to 28.2%. And the other big jump is at the 111K mark, where it jumps from 32.79% to 38.29%. So this means that again, when we use our RSP, it's a lot more beneficial to use it when we're in a higher tax bracket, especially in one that has a huge difference in the tax rate compared to the lower tax bracket. Here, I do agree that you should contribute into your TFSA first before your RSP if you know for sure that you're going to make more than 111K of income in the next 3 years. So what if you're already making over 110K? Then it leads you to the next question, which is, do you expect your income to be higher than it is today when it comes time to withdraw the funds? The rationale here is that if you're in a higher tax bracket when you withdraw the RSPs, then the taxes you need to pay would be more than the tax savings that you would have received in the earlier years. Because RSP withdrawals are considered taxable income. So whatever amount you withdraw from your RSP, it gets added onto your total income for income tax calculation. While this is true, it's also missing an important point about the RSP, and that is it fails to factor in the time value of money, which means the money that you receive today is worth a lot more than the money you receive further into the future. With the RSP, you get a chunk of tax savings every year by contributing into it. And you could have reinvested all those tax savings towards the RSP and into your retirement. And the growth from all those tax savings over time would be more than enough to cover the tax bill in the future. So you would actually end up having more money compared to just saving into your TFSA. We've ran calculations for clients in the past where even if they're making the same or higher income than they are today by the time they withdraw their RSP, it still makes more sense for them to contribute into their RSP because of the compounding effect of all the tax savings. So I would say 9 out of 10 times, you're still better off prioritizing your RSP before TFSAs if the purpose is for your retirement. Unless you're in an extreme situation where you're expecting to be making 200K or more, even during your retirement years. If you want us to show you a client example and the math behind this in another video, let us know in the comment section below. Now let's talk about the other considerations that I think was completely missing from the chart. First, under the question, what are you saving for? I would actually add another category for full-time study because RSP allows for tax-free withdrawal of 20K under the lifelong learning plan when you or your spouse enrolls in a full-time program in an eligible university or college. So if going back to study is something you or your spouse is considering, then it would be better to save into your RSP instead of your TFSA, assuming you don't already have 20K inside. Another consideration before using RSP is if you plan to retire in another country besides Canada, because RSP is subject to withholding tax for non-residents. If you're planning to retire elsewhere, then you should factor this in when doing your calculations, or consider withdrawing the money earlier while you're still a tax resident of Canada. However, if it's still too soon to have a clear idea where you want to retire, then I would say this shouldn't be a big contributing factor when you're deciding whether or not to save into RSPs. Because from what I've seen with different clients, life happens and a couple years down the road, you might have a completely different perspective on where you want to retire. And the last consideration is if you have a large investment portfolio or you have multiple investment properties and you're expecting a huge capital gain from selling them, then you might want to hold off on using your RSP room because you want to save the RSP for that year to offset the taxes. And if you have other considerations that affects your decision making as well, do let me know in the comment section below as well. Of course, these types of charts are oversimplified and only meant to provide a general guideline because it assumes you're putting all your money towards one goal only. But in reality, most people have multiple goals at the same time. For example, you might want to save for your first home, but you might also have other vacation plans or buying a car. So there's definitely more to it than the couple scenarios that we see in this chart. So if you're determined to be smart with your money and not miss out on anything that could get you to your goal sooner, whether it be buying your home or buying your dream car or retiring early, a great place to start is by continuously learning and increasing your financial literacy, like what you're doing now by watching these types of videos. So before you start saving into your TFSA, be sure to check out our video here on the #1 TFSA mistake, where we also counted down the top 6 mistakes Canadians are making. And if you're serious about optimizing your financial plan, consider working with a financial planner that can give you tailored recommendations, because chances are they can help you make tweaks that you didn't know about. And these small tweaks added up over time can make a drastic difference in your future. Thanks again for sticking till the end, and be sure to hit the like and subscribe button so we can see you in the next one.